In this video, we're going to have a look at the range of recession indicators, particularly in the US, just to get an update on the state of play there. And the first one I'm going to look at is our chart that shows, well, in fact, it's equity medium-term risk indicators, of which some of those, or quite a lot of those, have been associated with recessions. So I want to just highlight a few of these indicators, and these are just Z-scores going back over the past 25, 30 years. And on the far right, output gap is showing, so a high number represents a high risk. So the output gap with the US apparently operating well above capacity, this is coming up as a risk factor. Likewise, the yield curve being very flat, recently inverted, but very flat at the moment. That's the 10s, 2s. So that's showing an elevated reading. And then we go through property prices relative to trend, slightly elevated. Not too much of a concern now on the real Fed funds relative to neutral. That's in fact improved. The red dot is the most recent observations compared to 6 months ago. We've also seen considerable improvement, obviously, in the change in the Fed funds rate. Household debt service ratios are quite low. One of the other areas that is slightly elevated is the corporate debt service ratio, and that's reflecting increased debt levels. And then when it comes to the other indicators, valuations come up. So some of these traditional medium-term risk indicators have been flashing some concern for some time. Let's have a look at those in a little bit more detail. And the first one I'm going to look at is the output gap, and we're using the unemployment rate relative to NAIRU as our measure. And then the shaded periods here are recessionary periods. So you can see in the case of the US, the unemployment rate around about, according to recent estimates, about 0.5% below the full employment unemployment rate, which is estimated to be just over 4%. Albeit very difficult thing to measure. And you can see the recessions going back in time. So, on this basis, at least the US would appear to be late cycle growing above capacity and continuing to eat into capacity, and often associated with recession risk within a sort of a 12 to 18 month time horizon. So you'd have to think that that is presenting some sort of risk. What about the level of the neutral Fed funds rate? And as I said, we're looking at, these are more medium term sort of classic business cycle Fed inspired recession risk indicators. The next one is just looking at the Fed funds rate relative to neutral. The real Fed funds rate is the red, the neutral is the blue line. So the red goes above the blue, policy's tight. So tight in the late 80s, early 90s, tight from about mid-95 through to 2000, again in 06, 08, and then very briefly in 2018. So recessions have occurred on each of those occasions, and the yield curve is shown down below. This is the 10s, 2s has obviously been inverted, leading in and coinciding with the periods of tight policy, as you can see there. So I guess what's different on this occasion is that the Fed funds rate hasn't really gone sustainably above neutral, although the risk is, of course, that the estimate of neutral is wrong and that perhaps it was a lot lower than we all expected. But the recent estimates have it around 0.5, 0.7. It looks like the Fed funds rate only got just above that. And the 10s, 2s never really inverted in any sort of sustained fashion, at least not until now. So that's the state of play of some of the sort of classic late cycle output gap, low unemployment, Fed ending the cycle, if you like, or playing a big part in ending the cycle. And the final one, while we're talking about that, is the wages growth numbers. You can see that wages growth in the last 3 cycles in the US has picked up to in excess of 4% on each of these occasions, and certainly heading in that direction late last year, but it's since subsided somewhat. So that is also, I guess, flashing amber at the moment. So back onto the yield curve. Now back in August, with the yield curve sitting at about minus 50 basis points, the New York Fed model, or probability recession model, had probability recession sitting around about 40%. That's where the cursor is there. And then, of course, the curve started to I suppose, re-steepen during September and then further during the course of October. And the most recent observation on their model had the recession probability dropping to about 29% and was using a yield curve of 3 basis points. Now, over the past couple of weeks, the yield curve has steepened up a bit further. So one suspects that, if we were to update this model now, that it would have a recession probability maybe in the 20 to 25% range. So considerably less than what it was even back in August. But should we be happy and confident that a recession has been avoided with the yield curve moving back into positive territory? Well, no, because if we look at previous recessions, we look at the 2007 recession, the 2001 and the 1990s, the curve was re-inverting moving back to a positive position ahead of the recession, in the sense that damage had been done. It was too late. The recession was well and truly on its course. So there is still a risk that we need to keep in mind, that the curve in fact had moved to an inverted position. And we can see here, this is looking at the 18 months prior to each of the past 3 recessions. You can see in 2001, this is the 10-3 curve, basically troughed about 3 months prior to the beginning of the recession and started steepening up, and by the time recession started, it was about 80 basis points positive. Likewise, in July 90, it was about 80 basis points positive after troughing, say, 6 to 8 months earlier. And then, of course, in 2007, the yield curve reached its trough probably 9 months prior to the recession at about minus 40. And by the time the recession started, was to 100 basis points. So basically, the Fed had started to move policy, but it was not enough to avoid recession. So I guess the question is still open. Has the damage been done already on this occasion? What about other recession indicators other than the yield curve? Well, another model is the excess bond premium. So basically looking at credit markets and trying to judge based on credit spreads what the likelihood or probability of recession is that's being implied in spreads. And what we see there at the moment, the latest reading, I think it was for October, was sitting around about 9%. So really at the low end. It doesn't get much lower than that. So essentially the credit markets are implicitly saying that the probability of recession is very, very low. Default rate expectations are very low, quite in contrast to the yield curve model. To some extent, just as the yield curve may be downplayed by some, this credit spread premium model could be downplayed on the basis that investors are chasing yield and leading to a sharper than what might be a more accurate reading in terms of recession probability, so spreads coming in quite sharply. So that's certainly not pointing to a recession risk at the moment. We're just going to go now through a few of the other indicators in the US, just as a bit of an update. We'll just start with the ISM. This is just the ISM new orders. Now, the problem with this, yes, each time we've had a recession, and it has gone through the 50 level. Let's just get rid of that. What you see at the moment is the new orders obviously back through the 50 level, but there's last 5 occasions you had recessions, but there's also been another 5 or 6 occasions where it's been below 50 and we haven't had a recession. So not always a great indicator of recession. So that's sort of line ball at the moment. Looking at some of the other indicators, we'll have a look at some of the corporate sector ones, but let's just look at the housing market. This is the NAHB Builder Sentiment Index, and that's in the previous recessions, you've seen that fall away, quite sharply towards the end, albeit from pretty high levels. But in fact, its performance in the most recent period has been quite solid, starting to pick up again in response to lower mortgage rates. So a lot of the housing indicators in the US have sort of pushed up from quite weak levels. Average weekly hours, looking at those on an annual basis, you can see that average weekly hours has been declining and is fairly weak, although we've seen it at these levels in 2004, a couple of times during the 1990s, and then also in the mid 80s. So similar to a lot of the other indicators, it's poor, but not always consistent with recession at these levels. If we now turn our attention to some of the corporate sector indicators, and we'll just have a look at those shortly. There's also been quite a bit of a discussion around business confidence, because that's the area that has deteriorated quite significantly in the US. And you can see on the chart here that this is the OECD measure of business confidence that has come down quite sharply over the past 4 or 5 quarters to levels last seen really 2016, and we've seen it before again in the mid 90s and the mid 80s. So beyond this sort of level has been associated with recession just about every time, maybe with the exception of the mid 90s. So it is at a critical juncture just at this stage, and obviously one of the reasons, or the transmission mechanism from confidence to the economy is typically through capex and also hiring. If we have a look at one measure of capex intentions, that's the Philly Fed CapEx Intentions Index. Now, it's a volatile measure, we know, but it's even though it has come off from where it was in 2017-18, it's still at reasonable levels. So it's not yet following the decline in business confidence. Although if you have a look at some investment type numbers, and we'll just put those up here, investment spending has fallen back, basically flat over the past 12 months. Looks actually a bit worse over a 6-month period. In fact, let's just change that to 6 months. And you can see there that it's in negative territory. So it's actually declining on a 6-month basis. Again, this has occurred on a few occasions, 2016 being the most recent example, and mid-80s also being another example. So that is a somewhat of a concern at the moment. And also, if we think about the divergence between business confidence and consumer sentiment, can be an interesting way to look at this. We'll put those on the same scale. So here we've got the pink line, or the red line is consumer sentiment, the blue line on the right-hand scale, and the blue line is business confidence. So quite a divergence. Consumer confidence still fairly healthy. Business confidence come off. Now, we've seen periods in the past where the two have diverged quite significantly, particularly coming out of downturns. In 2010, business confidence picked up quite quickly, and it took a long time for the consumer to get on board. And then likewise, if we look at the period sort of mid-90s to the late 90s, consumer confidence was very strong, notwithstanding business confidence actually oscillating around a fairly average type level, only for business confidence to fall away quite sharply, and then consumer confidence fell with it. So look, it's just interesting to look at the divergence. Consumers responding to wage gains, employment growth, and I guess that still holds the key. And at this stage, employment growth, payrolls, initial claims for unemployment insurance are still holding at reasonable levels. Of course, the risks in this cycle may in fact be not emanating from the US, but from Europe or China more specifically. Just have a quick look at some of the European indicators. We all know that the German economy has fallen very sharply over the last 12 to 18 months. PMI sort of sitting down at the 42 level. We've only, through the level seen in 2001, and only achieved worse outcomes during the financial crisis. So that's a very significant downturn. Germany, of course, is a very export-oriented economy, very exposed to the downturn in trade that has occurred. Sweden is another one that seemed to be a very highly exposed to the global economy market. And if we put that on the chart as well, that's the red. You can see a very sharp downturn just in the last couple of months, from sort of above 50 to sub 50, joining Germany down there. And that's been somewhat concerning. So conditions deteriorate quite sharply during August, September, once again in Europe. And if we look at the unemployment rates, we can also see, if we just get this up here, and add the German unemployment rate. Now that's over in the right-hand scale, so obviously, down at very, very, very low levels. So the consumer construction sector is still doing quite well in Germany. Unemployment rate's very low, but if that was to start to turn up, then that would be obviously a real concern. And if we look at again, a smaller economy, more open economy in the case of Sweden, and the Swedish unemployment rate we can see here is sort of pushed up just in the last few months. Now there's some talk that there's some measurement issues related to that, but we have seen in the past that it tends to be a much more volatile unemployment rate than for the rest of Europe and for Germany, and often gives an early signal, an early sign that conditions are going to deteriorate more broadly in Europe. So that's somewhat of a concern and bears watching over the next few months. Thank you.